Hello everyone, I am Dr. Swati Gupta and today I am going to explain the PEG ratio, PEG ratio, price earning to growth ratio. It is a financial metric used to evaluate whether a stock is fairly priced. It compares a stock's PE ratio with its expected earnings growth rate. The PEG ratio is an extension of the P ratio and considers the expected growth rate of a company and making it a more accurate way to determine if a stock is overvalued or undervalued. In simple terms, we can say that PEG ratio measures the relationship between a company's P ratio and its expected earnings growth rate. Formula for PEG ratio is equal to P ratio divided by earnings growth rate, where P ratio, price of a stock divided by its earning per share divided by its EPS. I have already explained P ratio in the previous videos. Now, earnings growth rate, it is a projected annual growth rate of a company's earnings and it is expressed as a percentage. Interpretations of the PEG ratio. If PEG ratio is less than 1, it means the stock may be undervalued, suggesting its price doesn't fully reflect its earning growth potential. If PEG is equal to 1, it means the stock is fairly valued with its price aligned with its growth. And if PEG ratio is more than 1, it means the stock may be overvalued as its price is higher than its growth prospects. Now we will try to understand this PEG ratio with the example of two companies. Suppose there is a company A which stock price is rupee 100 and its EPS earning per share is rupee 5. So the P ratio is equal to 100 divided by 5 is equal to 20. Expected earnings growth rate is equal to 25%. So PEG ratio is equal to P ratio divided by expected earnings growth rate. 20 divided by 25 is equal to 0.8. Now, we assume that the stock price of company B is rupee 150. Its EPS is rupee 6. So, P ratio of company B is 150 divided by 6 is equal to 25. Expected earnings growth rate is 15%. So, PEG ratio is equal to 25 divided by 15, which is 1.67. When we analyze both of the companies, we find that company A PEG ratio is less than 1, indicating the stock may be undervalued and attractive for growth investors. While company B PEG ratio is greater than 1 and suggesting the stock is likely overvalued compared to its growth prospects. When to use the PEG ratio? First, growth stock screening. The PEG ratio helps investors identify growth stocks that are reasonably priced relative to their future earnings potential. As we saw in the above example that company A PEG ratio is less than 1, that's why it is more attractive for growth investors. While company B PEG ratio is greater than 1, it suggests the stock is overvalued compared to its growth prospects. Second, sector analysis. The PEG ratio is particularly effective for comparing companies within the same industry or sector, especially those in fast growing industries. In industries like tech, biotech, or renewable energy, companies often have high PE ratio due to growth expectations. The PEG ratio helps investors differentiate between companies that are truly growing or those whose prices are inflated without sufficient growth. Third, Portfolio diversification. The PEG ratio helps investors to include undervalued growth stocks in their portfolio and diversify the portfolio. Now, advantages of the PEG ratio. First, incorporates growth. The PEG ratio incorporates a company's expected earnings growth rate and gives a more comprehensive view of valuation compared to the P ratio alone. This makes it particularly useful for evaluating growth stocks where future earning potential is an important factor. Second, identifies undervalued growth stocks. If a PEG ratio is less than 1, it gives signal that a stock is undervalued relative to its growth prospects, and this helps investors to identify opportunities where a company's price doesn't fully reflect its potential for future earnings growth. Third, industry comparison. The PEG ratio is an effective tool for comparing companies within the same industry or sector, especially those companies with different growth rates. It helps investors differentiate between companies that may look expensive based on P ratio but are justified due to their strong growth potential. Fourth, mitigates P ratio limitations. The P ratio only considers current earnings, but the PEG ratio adds the dimensions of growth and making it more reliable for evaluating fast growing companies. Now, limitations of the PEG ratio. First, reliance on growth projections. The PEG ratio depends heavily on future earning growth estimates, which are predictions rather than guarantees. These estimates are often based on analyst forecast or company projections, which is uncertain. For example, a company might project a 20% growth rate, but if it only achieves 10% due to increased competition or market downturns, the PEG ratio calculation will be defective. Second, ignores qualitative factors. The PEG ratio focuses purely on numerical data and doesn't consider qualitative factors such as business risk, competitive scenario, and management quality. For example, two companies might have similar PEG ratio, but one company operates in a stable industry with strong leadership while the other company faces significant risk. So, if we are not considering these qualitative aspects, the PEG ratio alone can give an incomplete picture. Third, not suitable for all companies. The PEG ratio has limitations when applied to the companies with negative earnings or companies with unpredictable or fluctuating earnings. Fourth, short-term bias. The growth rates used in PEG ratio calculations are typically based on short to medium-term projections. Generally 1 to 5 years, this focuses to a short term and not reflect the company's long-term performance or potential. Concluding it, we can say that the PEG ratio is a powerful tool for investors to identify growth stocks that may be undervalued relative to their earnings potential. However, it should be combined with other metrics and qualitative factors for a strong investment decisions. Thank you.